Did you know that your required minimum distributions could push you into a higher tax bracket, raise your Medicare premiums, or potentially increase the tax on your Social Security income? Many retirees don't until it's too late. Welcome to the channel. If you're new here, my name is Michael Baker, and for nearly 20 years, I've been helping people prepare and plan for their retirement. I've seen required minimum distributions catch even disciplined savers off guard. You've worked hard to build your nest egg, so let's make sure that you are the biggest beneficiary of your retirement funds and not the IRS. So what is an RMD? RMDs stand for Required Minimum Distributions. This is part of the agreement that we make with Uncle Sam once we have a qualified retirement account like an IRA, a 401k, or a 403b. The agreement looks like this. We get to put money into these accounts while we're working and saving. And when we put money in pre-tax, we get a tax deduction for putting those dollars in the account. However, in retirement, when we begin taking funds, that's when we pay taxes on the distribution. Well, some people retire and they don't necessarily need those funds right away. However, Uncle Sam has a start date for every single one of us. That is your required minimum distribution age. This is the age where you have to begin, or you are required to begin, taking money out of these accounts, whether you need it or not. If you were born between 1951 and 1959, your required minimum distribution age is age 73. If you were born after 1959, so if you were born 1960 or later, your required minimum distribution age is going to be age 75. This is the age where you have to start taking distributions from your qualified retirement accounts. In some cases, RMDs can create a hidden tax trap for unsuspecting retired couples. The RMD stacks on top of your other existing income sources. So things like pension income, Social Security income, interest and dividends from investments, all of these flow through to your 1040, but now you have to take an additional amount from your qualified retirement accounts. So if you were taking distributions before and they were beneath the minimum, you now have to take more money. If you are not taking anything from these accounts, well, now you must begin. And that income layers on top of all of your other income sources. Depending on how much money you have or the size of these RMDs, they could push you into a higher tax bracket. They also may affect how you pay IRMA, or income related monthly adjustment amount, the additional premiums for Medicare, and depending on where you fall with your Social Security and how your Social Security is being taxed, it's quite possible that it could create more tax on your Social Security. The biggest issue with RMDs is that they signify a loss of control. The R stands for required. The IRS doesn't politely ask, you are required to take these dollars. So once you have to begin taking them, you don't stop for the rest of your life. So what are some planning strategies? On this channel, there's going to be lots of videos with specific tax strategies to help people prepare and plan for not only retirement and retirement income, but also strategies that can help mitigate the impact of future RMDs. Some of these strategies are things like QCDs, qualified charitable distributions. This is where you can gift directly from your retirement account or IRA to a qualified charity. You want to understand the rules of how QCDs work, but they're a phenomenal tool for those who are charitable and also want to mitigate the tax impact of RMDs. Roth conversions. Dollars that are converted into Roth will no longer be subject to future distributions. So for instance, if I have IRA dollars that I convert to a Roth IRA, those dollars are no longer in an IRA account, so they are no longer part of a RMD calculation. One thing that's important to note is that if you still want to do Roth conversions after your required minimum distributions begin, the first dollars out of the qualified retirement accounts go to satisfy the RMD. So you cannot convert an RMD to a Roth. You must take the RMD distribution first, then you're allowed to convert to Roth. So you want to make sure if you're looking at Roth and Roth conversions that you coordinate that strategy and understand how much time you have before the RMD rules kick in. Another way to plan for RMDs or future RMDs is having structured or strategic withdrawal strategies once you retire. In many instances, people want to defer or delay taking their IRA or 401k money to help them with income. They use other sources like brokerage accounts or even cash that they set aside. However, you may be in a very favorable tax bracket situation where it pays to actually look at using those qualified dollars. This is where careful and intentional planning can really pay dividends. If we can use or spend IRA dollars in a very tax efficient way, that can be a tremendous benefit in the long run, especially when it comes to thinking about the tax impact of future RMDs. A last thing to consider is something we refer to as tax diversification. Having Roth IRAs, brokerage accounts, cash, and then your traditional retirement accounts. This creates tax diversification where you can create flexible strategies where you blend withdrawals or you have a strategic withdrawal structure to help keep your tax bill as low as possible over your lifetime. Tax planning and tax strategy is all about optimizing for taxes for the rest of your life, not necessarily paying the lowest tax bill this year or the lowest tax bill for a short period of time. We want to think longer. We want to think about efficiency over your retirement, not just for a short period of time. RMDs look and can seem very simple, but let's not underestimate the ripple effect that they can have on your taxable income. Planning ahead can give you more control, fewer surprises, and potentially allow you to avoid unnecessary surprises when it comes to taxes. And I'd love to know from you, have you already started taking RMDs, or are you waiting until the IRS requires you to take those distributions? Drop a comment and let me know below. Remember, retirement planning isn't just about avoiding taxes. It's about smart and intentional planning so that the IRS doesn't get more than its fair share. If you agree with that, give me a like on this video. Hey, if you want to make sure that you're not falling into the RMD tax trap or have issues with other income sources, click the link in the description below to schedule your retirement vision call today. We'll help you understand what rules may apply to your situation and help you create a plan for the road ahead. Remember, retirement isn't just about avoiding taxes. It's about planning wisely and intentionally so that the IRS doesn't get more than its fair share.